types of loss in return for money. So now we're going to talk about reinsurance. Reinsurance is basically where one insurance company is insured by another insurance company. The whole purpose is to transfer or share that risk. It's typically when there is catastrophic risk or when insurance is needed for a specific amount. It's maybe something like $500,000 or $1 million. So reinsurance is when insurance is sold and purchased between two insurance companies. So you can see the example question down here at the bottom. It says, what is it called when an insurance company transfers part of a risk or part of the premium to another insurance company? That's going to be reinsurance, right? They're sharing that risk. So there's a few terms underneath of reinsurance that we're going to want to be familiar with. So with reinsurance, you have a few different parties. You have the reinsurer and you have the ceding insurer. The reinsurer is the insurer that is selling the insurance. And then you have the ceding insurer is the insurer that's buying the insurance. I'll break that down. So for example, let's say Bob owns the Eagles Stadium. He takes out a policy through State Farm. State Farm then purchases insurance through Allstate. In this scenario, Bob, of course, would be the insured, right? He's the one that's taking out the policy through State Farm. So Bob is the insured. State Farm is the one that's purchasing the policy from Allstate, right? So State Farm in this scenario would be the ceding insurer, right? State Farm is the insurer that's buying reinsurance from the reinsurer, right? So State Farm in this scenario would be the ceding insurer. And then Allstate in this example would be the reinsurer, right? That's the insurer that's selling reinsurance to the ceding insurer. A good way to look at this is you can think the ceder sits down and lets the reinsurer come in and help, right? So State Farm is sitting down, right? They become the ceder. They sit down and have Allstate insure them, right? So when we break these terms down, reinsurance is basically an insurance company getting insured, right? So it's an insurer getting insured. Reinsurance, right? So it's insurance for an insurance company. That's number one. And then if we break these terms down, reinsurer is the insurance company that is selling the insurance, right? So the reinsurer is the insurer that's reinsuring the insurance company, right? So they become the reinsurer. The ceding insurer, again, you can think they sit down and get reinsured, right? They become the ceding insurer. They take a seat and get reinsured. As far as Bob is concerned, right, as far as the insured is concerned, they do not have anything to do with Allstate in this scenario, right? As far as Bob is concerned, he has insurance through State Farm. With reinsurance, it is shared between the insurance companies. It has nothing to do with the insured. So this is shared and transferred amongst the companies through the insurance companies themselves. Nothing to do with the insured. Let's talk loss. So we talked about in general what is loss, right? Which is the source of damage underneath a policy. But now we're going to talk about the different types of loss. So generally speaking, we have direct loss and we have indirect loss. I mentioned another thing that makes the exam tricky is the different terms that kind of mean the same thing. So indirect and consequential, they're the same thing. So you have direct and indirect, or it might be direct and consequential. So direct physical loss, that is any loss that happens to the property, basically. That is a loss where the covered peril was the immediate cause of damage. Direct physical loss is any property damage. Indirect loss or consequential loss is damage that occurs as the result of a direct loss. Indirect losses are usually anything financial. For example, let's say there was a house fire and the insured had to go stay in a motel for 2 months while the house was being repaired. The direct physical loss would be the damage done to the house, The indirect loss would be the cost of the motel, right? When we get to homeowners, that's called additional living expense, right? That would be an indirect loss. Another example would be in cars.